A little bit of calm after the bond market storm. Live from New York City this morning. Good morning, good morning. Equities just a little bit negative, down by 0.2% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, a crude rally stoking inflation concerns, UAW threatening to strike more auto plants, and a last-minute shutdown deal looking unlikely. We begin with the big issue, $95 crude.
The oil market is getting squeezed and getting squeezed hard.
You've seen commodity prices start to move back up to recent highs.
Oil price pushing higher in response to production cut news and supply constraint.
You have to think about what higher oil prices mean for economic data and then for the consumer.
This doesn't present a good story for the consumer.
Higher oil prices are affecting the calculations for inflation for consumers.
It's another factor that's like to keep inflation higher for longer.
Evidence that we're actually in an inflation roller coaster rather than getting out of the woods with inflation fighting.
The last number of miles to target inflation is going to be challenging.
We think it probably normalized towards $100.
$100, $105 a barrel. That's the last thing the Federal Reserve and the central banks needed.
It's going to make the Fed's job a lot harder. There's a real risk that oil prices trend higher.
We're not done with this tightening move.
Joining us now to discuss all springs, George Bory, JP Morgan's David Leibovitz. Gents, thanks for being here. David, first to you. Does $95 crude give you more confidence energy stocks will rally, or does it give you more confidence discretionary stocks will struggle?
Well, I think you've seen that very much play out here over the course of the past couple of weeks. Generally speaking, I think it means more for the energy story than it does for the consumer story. The reality here is that higher energy prices are a direct tax on the consumer, but the labor market is still relatively tight, and year-over-year wage growth at 4.5% should allow the consumer to play a little bit more defense there. On the other hand, you think about energy stocks, you think about the capital discipline that these companies have adopted over the past couple of years, you think about what they've done with their margin, and I think you're just going to have more of a direct pass-through from those higher oil prices through those companies to their bottom line. So I would take energy over discretionary in the near term.
Exxon, record high at the close yesterday. Discretionary so far this month, really struggling. George Bory, listen to the C-suite over at Bank of America. Listen to these quotes. We won't have a recession. Brian Moynihan, the CEO, the CFO, consumer spending 4% more year over year. Just how resilient, George, is this consumer in America?
Well, clearly the consumers held up very well over the course of this year. But as you point out, sort of the rise in both oil prices and now interest rates as well, it does present effectively a tax on consumers. And job market's helped. It's clearly supported the consumer in terms of income, as well as a fairly robust balance sheet, which has given quite a bit of cushion to consumer demand and consumer spending. It's difficult to see that continue at this rate going forward. And so when we see oil prices punch up to levels like we're seeing now, the forward-looking expectations for both growth and spending do start to come down.
George, take your pick right now. The list is so long going into Q4. Interest rates, crude, student loan repayments, headwinds all over the place. George Bory, is Q4 it? Because for a lot of people listening to programs like this, and I've said this a few times over the last few months, it's like the economist who cried recession. We've heard it again and again and again. Have people stopped believing it?
Well, I think the reality is there are a lot of buffers in the system, and we've seen those buffers, kind of get used up as we've moved throughout the course of this year. Financial pressures, the financial headwinds continue to mount. As we know, base rates, front-end rates are clearly in restrictive territory. The curve is inverted but steepening as bond yields go up. And what we think, and real yields are quite high, but what we think is happening right now, the bond market seems to be testing the Fed's resolve. Where the Fed is effectively given the all clear with higher for longer, and the all clear to bond markets to now start to test the upper levels of yields to be able to do the heavy lifting for the Fed and really start to kind of tighten financial conditions. You're seeing it here as well as in the rest of the world. So while the recession story sort of started much earlier this year, the reality is that those buffers in the system, prevented that from occurring, and those recession expectations continue to get pushed out. But the reality is financial conditions are getting tighter and tighter and tighter. Eventually, they will cause a recession. Eventually, they will constrain both demand and consumption. And that eventuality, we think, is not too far away, but it's clearly, sort of 3 to 6 months out at least.
We've still got to deal with the why we're seeing this move at the long end and focus on that a little bit more. The 10-year at the moment, 465. Just moments ago, high of the cycle, 468.61. Torsten Slok of Apollo put out an email this morning, David Leibovitz, and he went through a long list of reasons as to why we're seeing this move at the long end, on a 10-year, on a 30-year. He said this: the sovereign downgrade, Japan exiting yield curve controlled, Fed QT, fewer dollars for China to recycle in a falling exports environment, the US budget, and a large stock of T-bills and treasuries coming into the market. David, which one is it for you?
So that's obviously quite an exhaustive list. I think that there are really two things that are going on here. One very much has to do with what the Fed came out and said last week, and taking 2 cuts out of their 2024 forecast, I think was a direct signal to the market that they are going to stay higher for longer. And I think that a lot of what we're seeing here, to give credence to what my colleague was saying, is the bond market seeing testing the higher end of that range. I also think that there's a supply issue going on here as well. And we look at what's going on with the deficit. We look at projections for the deficit. There's going to be significant Treasury issuance here going forward. And there are questions about the ability of the market to absorb that, with the Fed, engaging in QT, foreign buyers not as interested in buying Treasuries. And, you think about the pension community, they are much better funded today. And a lot of people historically have pointed to them as a source of potential demand for bonds. But, I'm not sure that that's going to be able to fill the shoes that are being left behind by foreign buyers and the Fed. So a little bit on the supply side, but also a reflection of what the Fed did last week.
Just to breathe a little bit more life into that conversation, those comments, David. George Bory, I think they're important comments. The bulk of the move over the last month or so has been at the long end, 10-year, 30-year. 2-year hasn't done much. It's hard to make the case the data has changed too much. That supply story, if you just draw the lines, we go back to that Treasury refunding announcement of a few months ago, don't we, George? How dominant is that particular dimension of this bond market move?
Well, certainly, from a pure valuation perspective, bonds, do look cheap when we look at sort of where real yields are. And so we're kind of in the value zone overall, particularly as we look out to the long end and 10-year and beyond. But as you point out, week in and week out, we continue to see wave after wave of issuance, and we know that's going to continue. So the technicals behind this market are weak. The other factor is timing. As we go into the end of the year, as financial institutions and other investors start to square up positions, you're starting to see kind of liquidity start to kind of erode a bit, and risk appetite does start to wane. So it is a little bit of kind of an alignment of stars here that create a very, very weak technical backdrop, and allows the market, again, to emphasize what we mentioned before, to really test the limits of policymakers. We're at yield levels. They're hard to justify fundamentally. Yes, growth is better than expected. Inflation is coming down, but it's well above still the Fed's target. But it is moving directionally in the right way. To us, that means that it's very technically driven, and we know that the Treasury is going to continue to need funding as we move forward. So as those points align, there's not a lot of upend support, if you will, for the next new marginal buyer to step in. And so we look for higher and higher kind of clearing levels, awaiting some signals from policymakers or just true fundamental cheapness to allow the next wave of buyers coming in. So we're in a bit of a dead zone right now.
Or real weakness in the economic data. Let's talk about that data. Jobless claims out about 38 minutes ago. Mike McKee has that data for you. Morning, Mike.
Good morning, John. Well, we just got the third revision to GDP, and it is unrevised at 2.1%. But that's for the second quarter. And the reason we saw some interest in that and market reaction is because consumer spending dropped from 1.7% to just an 0.8 gain. Now, that's old data, but the Bank of America folks put out a note just a few minutes ago saying that consumer spending fell 0.3 last week, and it has noticeably dropped off since Labor Day, something to keep an eye on. As far as initial jobless claims, John, in the words of that famous economist Alfred E. Newman in Mad Magazine, what, me worry? It looks like the labor market remaining strong, hardly any change in a very low number for jobless claims, which is interesting because Austin Goolsbee, the Chicago Fed president, is speaking right now, and he's making the case that you shouldn't put too much weight on the fact that the labor market is strong and that the economy seems to be growing quickly. That doesn't call for additional rate increases because he says it's the unwinding of supply shocks, the composition of demand returning to more stable patterns, and Fed credibility are central to why I think it might be possible today to reduce inflation while avoiding a deep recession. So he's not calling for higher rates based on the data at this point. Now, of course, data at this point is the key issue going forward into next week. If there's a government shutdown and it's very short, it won't have much of an impact on policy. The September data has already been collected. It can't be released in a shutdown, but if there's no shutdown, that all comes out. And the next meeting is November 1st, so October data won't matter anyway. Longer shutdown could depress consumer spending, which is already, as we're noting, down a little bit, could raise unemployment if the government workers show up as unemployed, if it goes long enough. And the October data might not be collected. So that'll make the December meeting very interesting for the Fed if all of this happens. What do they do about it? Well, John, I'm going to ask.
I look forward to that, Mike.
We have Tom Barkin, the Richmond Fed president, on with us later this afternoon. And that'll be one of my first questions to the gentleman is, what do you do when there's no data? Are you able to make policy?
Don't miss that. 3:30 Eastern Time. Mike McKee, Richmond Fed President Tom Barkin. Mike, thank you, sir. David, just to you on the Fed speak, and looking forward to that interview later with Mike McKee. Let's talk about the projections. Not the happy talk about a soft landing. It's the objective. It's not the forecast, the baseline. No idea what any of that stuff means. Let's go to the median outlook over at the Federal Reserve. They've got core PCE back to 2% in 2026. And over that period, unemployment climbs no higher than 4.1%. David, do you subscribe to that one?
I'm not necessarily buying completely into what the Fed is selling, and I think it's important to remember that you always pass a soft landing on your way to a hard one. I think that the consumption data that we were just discussing is really key. You know, what's kept this expansion going has really been the state and the health of the consumer and the ability to deal with higher prices really without blinking an eye. I do ask myself, are we finally going to begin to see the impact of those higher prices show up in the form of weaker consumer spending? You know, yes, the labor market is very tight, but as we were talking about earlier, higher oil prices, the resumption of student loan payments, higher interest rates only impact economies and consumers and businesses with a lag. And so what I think you might be seeing here is demand beginning to fade. That says a lot about the ability for companies to continue passing on higher costs and really to defend their margins, putting profitability at risk next year. So to me, what the Fed is saying, it sounds great and looks great on paper, but I'm not sure that's actually how things are going to play out in real time.
You're not alone, David, that's for sure. David Leibovitz, George Bory, sticking with us, going into the opening bell about 17 minutes away. Equities slightly negative. We're down about 0.1% on the S&P with some movers into the open. Here's Abby.
Well, John, beneath that relatively benign surface, we do have some outsized movers, starting with one to the upside. GameStop shares are soaring, in fact, on pace for their best day since June after the company appointed Ryan Cohen, the hedge fund billionaire, and of course the chairman of the company, as CEO effective immediately. He will be receiving no compensation. Of course, he's a serial entrepreneur, so he will be free to pursue outside interests, filling a leadership void after losing their second CEO in 3 years. Workday, on the other hand, down 11.3%. New management there, they have pre-announced the downside. They've lowered the forecast for the annual subscription revenue growth to 17 to 19% over the next 3 years, missing the street estimates. And then CarMax, not doing all that much better, actually doing worse, down 11.4%. Their adjusted earnings missed just slightly, 75 cents versus 77 cents. But it does seem as though rising rates, the environment creating pressure for the car industry, this company in particular. Into today, up 31% on the year and 11% short interest. Investors wanted perfection or at least a clean quarter. They didn't get it. The stock is down.
Abby, thank you. More from Abby around the opening bell. Coming up, GOP candidates taking the stage for round two.
There was a lot of frustration in the debate last night. If they combine forces into one big candidate, they'd still be at only 30% in the polls. So I think their frustration is that they can't break through the Trump cloud.
Team coverage up next.
We need a totally new approach to China.
We're going to go after China.
We're in a Cold War with China. We are going to have real hard power in the Indo-Pacific.
This is where President Trump went wrong. He focused on trade with China.
We've got a Biden administration whose whole policy is appeasement. Economic independence from China, where we're decoupling.
China is the real enemy.
GOP candidates taking the stage in California, attacking one another. President Biden and absent frontrunner Donald Trump. US-China relations a main topic of conversation, including Trump and Biden's handling of trade and security. Former South Carolina Governor Nikki Haley weighing in.
We're going to go after China. This is where President Trump went wrong. He focused on trade with China. He didn't focus on the fact that they were buying up our farmland. He didn't focus on the fact that they were killing Americans. He didn't focus on the fact that they were stealing $600 billion in intellectual property. I will make sure every American is safe, and we'll do whatever it takes to make that happen.
Team coverage starts right now with Bloomberg's Anne-Marie and the current down in Washington, D.C. AMH, a big feature of the conversation overnight.
Absolutely, and this is going to be a big feature, Jonathan, until November of next year. Who can out-hawk who when it comes to China? I think when it comes to Nikki Haley, one of the standout moments of the night is when Vivek Ramaswamy was defending why he got on TikTok. Remember, he had called TikTok fentanyl of social media, but he joined TikTok, and he was saying, this is how I have an outreach to the youth of the Republican Party to get our message across, because our message is not resonating at times with them. And she said she gets dumber every time she listens to him. But Jonathan, when it comes to policies on China, and you look at what the Trump administration did versus the Biden administration, there's not a lot of difference, is there? The Biden administration has kept the tariffs on that Trump levied at China. At the same time, they've also ramped up export controls. What you do see, though, at this moment is the Biden administration trying to have a healthy dialogue with their counterparts in China. That potentially might mean a Xi Jinping, President Joe Biden meeting at the APEC summit in California in November. But when it comes to actual policy changes, Democrats, Republicans, you're going to be hard-pressed in Washington, D.C., who you can't find anyone who doesn't want to take an attack on Beijing.
And let's take a look at that conversation. Any reason to expect a change of course from this administration anytime soon?
Well, look, as Anne-Marie was outlining there, it was hawkish across the board. It does feel like now the Republican side are trying to drive a wedge between what the administration is doing, and that is President Biden has obviously been trying to stabilise relations with China in recent months. We saw last week, of course, the Treasury Department reopening communication channels with Beijing. We've had officials at the very senior level meeting, including Jake Sullivan and Wang Yi, for example. And, of course, all of this is meant to be building up to the US hosting APEC in November, when potentially President Xi Jinping may come and may potentially have a meeting with President Biden, which would be the first time since they've met together since Bali a year ago. But you have to say the political backdrop now, as Anne-Marie outlined, is very hawkish on the Republican side. That's clearly going to box in the room for manoeuvre on President Biden, and I think it will complicate the messaging and signals that he can send around that APEC meeting if he does get to meet Xi.
And thank you, sir. Let's see if that meeting happens later this year. And Karen, Anne-Marie, George Bory, David Leibovitz back with us. David, we started the year saying US versus the rest of the world. Given what's happening in the rest of the world right now, is the focus still US?
I do think you want to continue to focus on the U.S. You know, when we think about the data holistically, you were just talking about China. Obviously, that economy has its fair share of problems, having a lot of difficulty stimulating it effectively without leaning into the property sector. So not the brightest outlook for that part of the world. Obviously, that has impacts across the emerging markets. And then you layer on top what's going on in Europe, where things are not moving in the right direction. Those PMIs are firmly below 50, and we're not so sure that they're going to be able to get them back into expansion territory. So So very much would lean into the U.S. relative to the rest of the world. And I think that this is really an argument about quality. You know, the spillover effects work one way. If the U.S. catches a cold, the rest of the world gets sick. If the rest of the world is in the doldrums, but the U.S. by some measure is able to hang in there, we're not going to get infected by what's happening abroad. So continuing to lean into the United States at the end of the day.
George Bory, you've told us before, go global. Where, how, why?
I think growth-wise, as David mentioned, that makes a lot of sense. From a bond perspective, you know, sort of looking at yields internationally outside the U.S., bringing those yields back to the U.S. can be very advantageous for a bond investor. Obviously, bond yields are going up here and in other markets around the world, but when we look at swap differentials, so the cost, if you will, from moving from one currency to the other, investing in foreign currencies and bringing those currencies back to the U.S., transitioning those into dollars can really generate some nice returns and buffer a little bit of that upward move we've seen in yields and the downward pressure that puts on prices. So we like global government bonds. We like them swapped back to dollars, and that has actually been a nice boost to portfolios. As we know, the dollar has remained very strong, and so using the dollar strength to the benefit of a U.S. dollar-based bond investor is a really nice diversifier in portfolios. Now, economically, as we discussed, you know, the U.S. is clearly doing pretty well and better than the rest of the world. And so, you know, those soft landing dynamics, which are very much in place today, you know, can be played more through the credit markets, if you will. So we see good opportunities in things like shorter duration, higher quality, high yield. So there are different ways to play it, but going global is a very good diversifier for just a single kind of currency fixed income portfolio.
Different perspectives on different asset classes there. George Bory, thank you, sir. And David Leibovitz, to you as well. Gents, thank you very much. About 7-8 minutes away from the opening bell. Equities just slightly negative, down by 0.2%. Coming up in the morning calls and later, Franklin Templeton, Sonal Desai, joins us around the opening bell on why she sees inflation risks ahead. That conversation, about 7 minutes away. We came really close to 470 on a 10-year yield in the last hour or so. And even with that, equities just about holding in there. On the S&P 500, negative by 0.2%. On the Nasdaq, down by about a third. That's the price action. Let's get you some morning calls. First up, UBS initiating coverage of Duolingo with a buy rating and 195 price target, saying the company has a best-in-class brand within the language learning space. That stock is up by close to 2%, 157.28. Your second call from JP Morgan, lowering its Netflix price target to 455 from 505 ahead of Q3 earnings, reflecting recent comments from management around margin expansion. That stock slightly softer, negative by 0.6%. And finally, TD Cowen lowering its price target on Workday to 260 following the company's analyst day, citing disappointing takedown on growth and margin expansion. We're down there hard in the pre-market, off by 12.7%. Coming up, we'll catch up with Franklin Templeton, Sonal Desai at the opening bell on her inflation outlook. That opening bell is just around the corner. 23 seconds away from the opening bell in New York City. Good morning to you. Equities pulling back just 0.1% on the S&P. On the Nasdaq, down by about 1/3 of 1%. Yesterday, decent rally into the close, finishing just about positive on the S&P 500, even with the craziness in the bond market. There's your opening bell. Let's talk about that craziness in the bond market. Switch up the board and get to 10s. Yields up 3 basis points, 463.85. In the last hour, really close, within a couple of basis points away from 470 on a US 10-year. Over in Italy, a struggle, budget concerns, the European bond market down, yields up. In the FX market, a euro a touch stronger after having a little look at 104 in the past 24 hours. 105.47, that currency pair up by 0.4%. Earlier on today in a session, $95 crude for the first time this year on WTI. We pull back now by 0.8%, $92.90. We are about 30 seconds into the session. Let's take a sneak peek at the early price action on the S&P. We're down by 0.2%. On the Nasdaq, down by about 0.5. One stock to watch at the open is GameStop. The company appointing billionaire backer Ryan Cohen as its new CEO. Cohen acquired a stake in a video game retailer in 2020. That stock is higher by 3.5%. Abby has more. Hey, Abby.
Hey, John. Yeah, that's right. RC Ventures, Ryan Cohen's seed and venture capital firm back in 2020, did acquire a 12% stake. And it was a wild ride because at that time it started off with a one handle and then very quickly in months went up basically 9,000% to $120. It was one of the poster childs for the whole meme stock moment. So he, of course, is already the chairman. Now he's the CEO, replacing the second CEO to leave in just 3 years. He's starting immediately. No compensation will be received. Lots to deal with here because, of course, the gaming industry is really being revolutionized by digital gaming technology. So the top line right now has been languishing. The company has been unprofitable since 2019, just slightly right now, but that's one big issue, how to turn a profit. And in terms of addressing the fundamental shift in gaming, they do own 4,400 stores, a little bit more globally. You can also buy their products from their website, but it'll be interesting to see whether or not there are store closures. Now, in 2021, GameStop did raise more than $1 billion in a stock sale. They also last year surged after that they announced that they were going to attempt or stock split, their first in 15 years. It's going to be very interesting to see what Ryan Cohen does first as CEO, address the profitability, the top line, all of these issues. I have reached out for an interview to maybe gain some more detail here. It'll be interesting to see, of course, what happens here. Right now, though, the stock is up 2.5%. I think profitability will be a big deal. It's also worth noting there's a 20% short interest there, John, but I think with Ryan Cohen's backing, you still have the stock up basically 2,000% since he first took that stake.
Very cool. Watch this space. Abby, thanks for the update. Thank you. That stock is up by 3%. Let's turn to the chip makers. Micron predicting a steeper than expected loss in the current quarter. The company's CEO saying this: amid a challenging environment, Micron sustained technology leadership, launched a significant number of leading edge products and took decisive actions on supply and cost. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. It's a really mixed outlook from the biggest US memory chip maker. The stock bouncing around, but currently down around 5% on an intraday basis, putting it on a track for its biggest drop since June. On a closing basis, we're looking at a significant drop, the most in more than a year. What it's projecting is a loss of $1.14 per share in the fiscal first quarter. That's the quarter ending November. Analysts had seen a loss of 96 cents, so slightly deeper. The bright spot, or the other part of that mixed outlook, is that sales will actually be better than expected in that November quarter. $4.2 to $4.6 billion. The street was looking at something like $4.21 billion. This is a company that's notched 5 consecutive quarters of sales declines. It looks like they might return to high single-digit top-line growth in the quarter to come. And the commentary from Sanjay Mehrotra, the CEO, in an interview with Bloomberg is that those customers in end markets that had big inventories or excessive inventories have now worked through them and they're returning to ordering. It's just that the orders they're placing are relative to the demand for their end products. And as you and I have discussed for weeks now, John, the consumer electronics market in particular is still weak. And in data centers, that is an exception to the rule for Micron. They're saying that actually data center operators are still working through excess inventory when it comes to memory chips. The 2025 outlook looks much better. That is the commentary from Micron, that in 2025 things look better. Remember, DRAM and NAND chips, memory chips, highly commoditized. So we look at pricing as well. Pricing starting to stabilize. That is going to be the story for 2024, according to Micron. And some of the sell side notes kind of reflect that as well. Near term, there are concerns, including China. The US policy towards China is impacting sales, Micron said, but analysts looking past that and saying, OK, we see what you're saying about the long-term outlook, and we're starting to believe it. But the stock down almost 5%, John.
65, 64, 93. Ed, thank you, sir. Look out for Ed's show a little bit later, Bloomberg Technology, noon Eastern time with Caroline Hyde. They'll be covering that stock, no doubt. About 5 minutes into the session, we are lower here on the Nasdaq by, let's call it 0.25%, just about turning positive on the S&P 500 by 0.03. More earnings in the auto space this morning. CarMax reporting second quarter profit that came in below estimates. The company's CEO saying the following: we continue to drive sequential improvements in our business despite persistent widespread pressures across the used car industry. Simone Fuxman has this one. Hey, Simone.
Hey, John. Yeah, the company's also saying that affordability issues are what's to blame for sales that were 9% lower than a year ago during the quarter. Talking about inflationary pressures, tightened lending standards, and prolonged low consumer confidence, all three meaning there are a lot less sales and therefore a lot fewer cars that the company can make money on. If we dive into the numbers, the earnings per share slightly less than expected. We're talking 75 cents versus an expected 77 cents per share. Net revenue is actually a little bit higher than anticipated. But the problem when you're digging through all of this is that the margins seem to be pressured, coming in a little bit lower than Wall Street had anticipated. Still, though, generating a gross profit per retail unit of $22.51 in the quarter. That's relatively strong compared to some of its peers. We've seen the likes of Carvana, AutoNation, their shares falling in sympathy with CarMax this morning, but CarMax still potentially one of the better options in an industry that its CEO last quarter called obviously depressed. One interesting thing to watch here as we go forward, though, those strikes, the UAW strikes happening, could push up prices of new cars. Do we see more folks turn to CarMax to buy used cars? That's something we're not seeing play out in this morning, where shares are down about 10%.
Simone, thank you. 71.73. Before we talk about other names, I just want to give you an update on the bond market. Treasury's selling off again at the long end, 10-year, 30-year, 10-year at 5 basis points. Let's call it 466, 468, just about the high of the session that I've seen in the last hour or so, came really close to 470. The 30-year, very close to 480 at the moment, up 7 basis points. Other side of the Atlantic, look at two things. Look at Germany first, then look at Italy. German 10-year yield is higher by about 10 basis points, even with a softer CPI print. Go to Italy, it's higher by about 15. Look at the overall spread. Very briefly, in the last 30 minutes or so, just going through 200 basis points. The stresses across the board, softer bond market across the whole of Europe at the moment. Bonds down, yields up. They're up more in Italy, off the back of some concerns, some might say, around the Italian budget. So, bit of problems there, developing over in Europe, but certainly not unique, given what we've seen happen in the Treasury market over the last couple of months as well. Your 2-year on the Treasury market, 5.1%, 10-year, 465, 30-year, let's call it 480, very close. 479. Let's turn to fitness. Peloton shares climbing after the online workout company agreed to a deal with Lululemon to share fitness content. Peloton saying the deal reinforces the company as the, quote, clear leader in connected fitness. The stock falling close to 95% since its 2021 peak. Katie Greifeld has this one. Hey, Katie.
Hey, John. Yeah, with this context, this is a needed shot in the arm for Peloton. Shares currently up about 5% after linking arms with Lululemon. Now, as part of this 5-year deal, Peloton's fitness videos will be offered to users of Lululemon's Studios Mirror and its free digital app. And as part of the arrangement, Lululemon will stop producing its own exercise videos next year and will no longer feature third-party content. Now, it's important to note here that Lululemon actually plans to stop selling the Mirror hardware by the end of 2023, and the digital app will be discontinued for new users. So this agreement, it's geared more towards servicing existing customers rather than bringing in new ones. And as a result, you have the likes of Vital Knowledge saying that this is, quote, not a monumental announcement for either firm, though you do have Telsey Advisory saying that this deal is, quote, a vote of confidence in the quality of Peloton's content. Peloton shares, again, now up about 7% or so.
That's a name that really needs some good news. Katie, thank you very much. Talked lots about what's happening in this bond market, yields pushing higher. Sonal Desire Franklin Templeton seeing one more rate hike this year. Here's the quote from Sonal. Inflation has come down, but not enough. And with a strong economy and monetary policy that might not yet be sufficiently tight, the risk is that disinflation progress might stall. Sonal, I'm pleased to say, joins us right now. So I've been looking forward to this conversation all morning, and I had one question I wanted to ask you. Do you think we are sufficiently restrictive off the back of these moves we've seen over the last couple of months?
So, if we're talking about monetary policy, I'd say the evidence practically speaks for itself. Look at where unemployment is. Look at where this economy is. Absolutely, the labor market has begun rebalancing. I accept that. But everyone has just looked at the delta in terms of how much rates have gone up. And I accept they've gone up a lot. But you know something? Inflation should have come down a lot more. And I think we have been conditioned by the extremely abnormal low interest rate environment we've been in since the global financial crisis. Before that, from the 1950s until 2007 or so, this economy did just fine with short-end rates at being around 5%.
Are you saying that the Fed is also implicitly acknowledging that we're not sufficiently restrictive based on the forecasts and all that they put out recently?
Essentially, that is what they're saying, isn't it? They are saying, you know, I have heard a lot of criticism of the Fed's forecast, saying they're unduly optimistic because they haven't revised unemployment that much. They haven't revised growth that much, but essentially what we are seeing is higher rates. That's another way of saying that the actual underlying natural rate is probably higher. It's a stronger economy. It can bear somewhat higher rates. That's what I would take away from it. I happen to agree with them. So in this particular instance, I'd say I'm very much on board with what the Fed is saying here.
It begs the question, how will you know when we've fully internalized high for longer? How will you know when we are truly sufficiently restrictive?
So I think that you do know, because here's the thing. We will continue to see some pickup in unemployment. I think there's a lot of obsession over 0.1 moves. Again, for the longest time, full employment, unemployment, the naira in this country is closer to 5%. It's not closer to 3.5 or 4. So there is space for unemployment to go up. That is clear. Now, are we there at that point? It doesn't appear that we're anywhere close to there at this point. If I look at the recent move in treasuries, I think there is some absorption of this idea of higher for longer. I think we've got underlying fundamental reasons in terms of inflation. Inflation actually gets tailwinds right now between wages and oil prices and a host of other factors. And long-end yields actually have headwinds coming from technical factors, from both demand and supply, right? If you look at deficits, if you look at a variety of other factors of lack of demand, all of these factors I think are feeding in. But I don't think it's going to be a steady climb, right? The pace of the recent move in long-end rates, I think to some extent captures a certain amount of sentiment-driven concern from everything from government shutdown onwards. But I do think the direction is correct. I think long-end yields are likely to move higher, not consistently lower.
What kind of numbers, Sonal, do you think we can tolerate? And when I ask that question, I don't just mean from an economic perspective, I also mean from a markets perspective as well. At some point, as you know, these things can become self-limiting. It drives the demand because it inflicts so much damage elsewhere on the market. What kind of numbers are you thinking about?
I think you could, you know, so again, if I take a step back, Jonathan, and I say, okay, supposing the Fed is talking about, we take at face value the Fed's SEPs, and you end next year with Fed funds between 5 and 5.25. Now, Fed funds would only be at that level if we were not in a recessionary environment. If that is the case, you'd get an upward sloping yield curve, and fair value would tell you you'd need to be closer to 6%. I don't think we'll be there. I think we will be lower than that. Can the market absorb it? Depending on the pace, probably yes. There's a lot of concern on the commercial real estate front. These tend to be, it's still different from the mortgage issues that we saw in 07, 08, which were residential, so spread across the board. Commercial real estate is likely to be localized to those areas which have had the most pain, and thus to regional banks, for example, that have the most exposure. I'm not saying that we won't have stress. We will. The question is the quantity of stress and whether that would be enough to actually get the Fed to change what it believes is the correct course of action right now.
OK, let me squeeze this in then. So, favourite idea right now? I assume it's not going along the 10-year. What is it?
No, I think what we are doing is we are looking at value. Look, income is really important. We're seeing that whether it's in investment grade, mortgages, MBS. If you look at the MBS space, there are a variety of areas which MBS will give you lower duration and continue to feed you income. I think that at these levels, fixed income does look attractive, more attractive than it has, certainly for the last 15 years, from that perspective of delivering income. And I think that that's something which, you know, we've been waiting for this, mind you, since the start of this year, and it hasn't happened because people have been short, and it's been good for them, you know, to be in money markets, to be in very short duration assets. But I think we are at the point to start getting into those somewhat intermediate and longer duration pieces of fixed income as well.
Interesting. Sonal, thanks for the update. Let's catch up again soon. Sonal Desai there of Franklin Templeton on this bond market. Coming up, the UAW threatening to expand its strike against Detroit's Big Three.
The reality is there is a real wage pressure problem, and this wage story is a big thing. Everybody hears it all the time. So that helps drive the momentum behind, yeah, I deserve to get paid more.
Team coverage up next.
The reality is there is a real wage pressure problem. And even though there's a smaller percentage of the economy is unionized now than back last time we had a significant wage-related issue in the economy, the fact that we have 24-hour a day, 7 days a week, 365-day-a-year financial press, and they're looking for things to talk about, and this wage story is a big thing, everybody hears it all the time. So that helps drive the momentum behind, yeah, I deserve to get paid more.
The UAW setting another deadline, threatening to expand its strike against Detroit's Big Three on Friday at noon if negotiations don't see major progress. We've heard this before. Union President Shawn Fain scheduled to make an announcement on Facebook Live tomorrow at 10 a.m. Eastern Time. Sources telling Bloomberg Ford may not be spared this time around, with everything on the table. Team coverage starts right now with Bloomberg's AMH in Washington, David Welch in Detroit. David, are all three on the naughty step going into tomorrow?
Look, if I had to bet, I'd say this will be expanded. But it's a very crucial day tomorrow, because when he set the second deadline on this, where Shawn Fain expanded it, we sort of expected that. And we knew there was progress at Ford, but things were far apart with the other two. This time around, if he feels he needs to add pressure on Ford and put more plants on walkout, that tells you that things are really bogging down. And it'll also give us some better insight where things are with General Motors and Stellantis. Let's suppose he adds plants to Ford. My guess is if he did that, he would strike their parts distribution plants, which he already has on strike at GM and Stellantis. And if he didn't add plants at GM, it says that maybe there's some movement there and with Stellantis as well. So just reading the tea leaves and listening to what he says at tomorrow at 10 o'clock will tell us where things are. But this is very crucial, again, because I figured he was going to continue the strike no matter what last time. Now we've been out longer. He scored a big public relations coup, getting Joe Biden to come to the picket line this week. So, he can really focus on getting down to negotiating, getting down to brass tacks at this point. So big day tomorrow morning.
Let's talk about that PRQ. AMH, at the moment, Biden got the audience he wanted. Did the former president?
Well, the former president went to a non-union factory, actually, and spoke to those workers. But yes, they are working class, blue collar workers that I think his trip just underscores how important this voting bloc is. A union household or anyone attached to the unions is for the Republican Party. It was also mentioned, Jonathan, in last night's debate. Mike Pence took a swipe at President Biden, saying he shouldn't be at the picket line. He should be at the unemployment line, trying to talk about the consternation that you see underlying a lot of this with union workers. And that's the fact that it's going to take less of them, even if they're used to make an electric vehicle. But we know that UAW leadership does not like the former president, Donald Trump. Shawn Fain has said he's part of this billionaire class. But in a more searing statement, Jonathan, the UAW leader who's negotiating with General Motors, this is what he had to say to the Detroit Free Press. This was his statement from Mike Booth. Let me be blunt. Donald Trump is coming off as a pompous expletive, he couldn't print that word, coming to Michigan to speak at a non-union employer and pretending it has anything to do with our fight at the Big Three is just more verbal diarrhea from the former president.
The latest politics. AMH, thank you. Alongside David Welch, fantastic coverage over the last week or so. New deadline sounds like the old deadline. It's noon Eastern tomorrow with a news conference. Facebook Live tomorrow, expected to take place at 10 a.m. Let's get you some sector price action about 23 minutes into the session. Here's Abby.
Well, John, we're looking at a very small decline for the S&P 500. Not a lot of drama beneath the surface. We have real estate and materials, financials up top, but up less than 1% to the downside. Utilities, it's interesting to see the rate-sensitive sector split, but also down less than 0.5%. However, we are heading to the worst month of the year for the S&P 500. Most sectors are down. Let's check in there because this is very interesting. The worst sector, real estate, then tech. So both of these sectors sensitive to rates in different ways. Real estate and utilities because of the dividends, tech because of rising rates make valuation less attractive. Again, we're heading to the worst month of the year. Most sectors are down, John.
Abby, thank you. Just about hanging in there on the S&P 500, just about unchanged. Your trading diary up next. Stocks just about positive. Let's get you to the trading diary. The week ahead, the next couple of days, look like this. More Fed speak through the day from Chairman Powell, Cook and Barkin. After the close, earnings, Nike a little bit later on. Friday, we get the Fed's preferred inflation gauge, PCE deflator. Saturday, the government shutdown deadline coming at midnight. And next week, more key data, including September payrolls, which could well be delayed if Congress fails to fund the government. 2 interviews you do not want to miss. Mr. Barkin at the Richmond Fed sitting down with Mike McKee and the former Vice President, Mike Pence, with Anne-Marie and Joe Matthew. All of that coming up later on Bloomberg TV.